Evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP. And today we are going to cover a very fantastic video which is on Indian Fiscal Monitor. As we already told you that our YouTube channel keeps covering our very latest video, and in a month or so in a month 2 times we always try and cover the Indian Fiscal Monitor. So whatever you see, this is Indian Fiscal Monitor January 2nd 2017. This data has been compiled by Treasury Consulting LLP, but we are not sharing this PDF with anybody, to be honest. So this is all about what we have in Indian Fiscal Monitor. Sensex has been down. We all know that Sensex is going down, down, down. In a year ending 2016, Sensex delivered a return of roughly 2.5%, which is very low. On the other hand, Nifty delivers a return of roughly 3.6% that you can very well see here. So I don't think that why the markets are so bull on Sensex, that Sensex will do this. In fact, I still remember that January 2016, Citibank given a prediction that Sensex will touch 40,000. In fact, at that time also I wasn't in agreement of the fact that census would touch 40,000. But nonetheless, that is something the predictions keep coming. In our prediction, we are predicting that by 2017, Sensex would be roughly 28 to 29,000. We will see a growth rate of roughly between 3 to 4% in Sensex, and Nifty is roughly 3.5 to 4%. Bank Nifty we will also see Bank Nifty we will see fall, to be very honest. My personal opinion is that Bank Nifty will see fall, to be very honest. In terms of foreign institutional investors, you all know that foreign institutional investors were sellers during the year, but somehow accumulately they added roughly 19,000 or approximately 20,000 crores. During 2017, our prediction is that foreign institutional investors would sell, and they would be sell with a huge amount, because I would see that in fact Treasury Consulting LLP would see that it is going to be the dollar bull year. And as regards the dollar bull year is concerned, we see say probably foreign institutional investors selling of roughly 40,000 odd crores. On the other hand, we also predict that the domestic institutional investors, shortly known as DII, which people mention here mutual fund, but it's going to be it's mutual fund and insurance companies and all. We see that domestic institutional investors would continue to add pump money, but after demonetization, we would surely see an impact of 3 to 4% on the GDP. But at the same time, Treasury Consulting LLP is not reducing the firepower of few organizations like Life Insurance Corporation and others, to be very honest. We also see that we never been in agreement with the Indian inflation figures which they are showing every time here, and we never been in agreement with the GDP of the India. I don't think that India is growing with the GDP of 7%, considering everything what is happening around. During 2017, of course, the impact of demonetization would be there. We see that Indian GDP would grow by I think roughly between 4 to 4.5%. And at the same time, we also see that the Indian inflation would continue to remain adamant at greater than 10%. Unfortunately, in India, the CPI inflation is between 5 to 6%. I don't think India anywhere is facing an inflation of 5%. India is facing inflation greater than 10% if we seriously see the figures, if we seriously evaluate this. But you know that window dressing is everywhere, from a large corporation to a small corporation, something which we cannot control, right? One beautiful thing which has happened here in the last few weeks, that the 10-year yield have grown to 10-year yield have grown to 6.97%, which is approximately 7%, which is a good show. There is no doubt about that. And because it was fallen to 6.38%, I don't think that the yield would continue to down. I think that the yield of 10-year would rise, considering the fact that being a dollar bull year, India left with two options. Option number one, to continue to follow accommodative monetary policy, and option number two, to go ahead and increase the repo rate. I think that India would increase the repo rate against all expectation of following accommodative monetary policy if they seriously not interested to have a reverse carry. So I see two or three times hike in 2 or 3 times hike in repo rate, but I don't think that the hike would be very substantial. It would be 25 basis point or so. Nothing concrete, to be honest. If you look at this chart here, you will make a lot of sense. You will get to know where yields are falling. Indian call rate are trading at 6.25%. Indian repo rate is also at 6.25%. So I don't under though it is approximately same. Indian repo is also 6.25%. 10-year gilt is 6.97, the latest one. On the other hand, the previous one is trading 6.5 something odd. Commercial paper rates are rates. If you the commercial paper rates are also near about 6.75 to 6.7 something, except 1 year and 6 months, which is 7.5. Certificate of deposit rate is also that. So what I would like to substantiate here is, if apparently we see this column, which is 30th December column, which I am highlighting, this 30th December column, you will make a large sense. The sense is that, majority of the rates in the Indian fixed income market, be it your call rate, repo rate of course is not fixed daily, be it your call rate, be it your 10-year Indian 10-year government bonds, be it your certificate of deposit, and be it your commercial paper, you will get to know that majority of the rates are plus minus 100 bips around repo. Of course, when we say that, we always say plus minus 100 bips, but it is always plus. It is plus minus 100 bips from repo. This makes a lot of sense. In fact, if we carefully see that there is a very good amount of work which Reserve Bank of India is doing in terms of managing the interest rate, but at the same time we should not forget that Reserve Bank of India is also doing a huge monetization of the national debt, and this is something a cause of concern for me. So my cause of concern is not that all the rates are moving plus minus 100 basis point for repo. My cause of concern is that the way Reserve Bank of India is managing the interest rate, scenario in this country, and at the same time able to generate a dividend of roughly 50,000, roughly 65,000 odd crores. This is something a cause of concern for me. How can that possible? And at the same time, the impact of liquidity adjustment front and the impact of the open positions like net overnight positions kept by the banks and others, they are not impacting the interest rate. Because if we carefully see that during Raghuram Rajan and especially during Subbarao, call rate used to move like anything. One day it is 10.5, second day it is 8%, third day it went to 7%, fourth day it went to again. Call rate used to hover. Now, when call rate used to hover, it makes lot of sense. It simply tells you that the power of the liquidity adjustment facility of the particular central bank. But if we carefully see now, RBI has made in such a way that they have kept all the rates plus minus 100 basis point near repo. All those people who are watching the video must be making sense that this is good, but I tend to disagree. I disagree with the thoughts that Indian repo rate, the management of the rates by Indian Reserve Bank is going to hit the transmission mechanism very badly. I tend to disagree with the fact that if we keep the repo rate plus minus 100 basis point, this matter. Although I would like to agree with the fact that if we keep the repo rate plus minus, then if we keep the repo rate, then it would surely going to hurt. This is what we all about today. My overall perception is that year 2000. My overall perception is that year 2017 would be a very very volatile year for foreign exchange market. We see that Indian fixed income interest rate would not fall, rather it would increase. I don't see that RBI, if they are intelligent, they will cut the rate. In my personal opinion, they should have increased the repo rate. In my personal opinion, MSF should have raised, rather using a formula of repo plus IRC. And at the same time, government should keep away from MSS bonds. I don't think we reached at the level when we need to have MSS bond. I think the time has come when the steps taken up by the Raghuram Rajan before leaving to increase the depth of the Indian fixed income market. I think these steps needs to be taken again. At the same time, because of the demonetization which has happened in India, and Basel 3, which is of course coming in 2019, not coming tomorrow. In that sense, I would see that a sudden, I don't see a lot of issuance would happen in the certificate of deposit. And when it comes to demonetization, I also do not think that the corporates are in a position to raise too much certificate or too much commercial paper. This could be one of the reason why the commercial paper rate and the certificate of deposit rate is within a band, is within a band. So this was for the today. I think that the interest rate management is something which is a very deep cause of concern for Reserve Bank of India. And I think that we continue to see the management of the interest rate by the RBI in 2017 also. Although I would again be surprised that liquidity adjustment fund and monetization of the national debt would still continue to be on the priority of the Reserve Bank of India. So this was for the day. We thank you very much for your time for listening to us. If you're watching our video, please don't forget to subscribe and all, and mention good words about us on YouTube. Thank you very much, and have a great day ahead. Thank you, and see you soon.